Now this chapter that we're going into now, this deals with capital budgeting. You might recall from previous videos now, we're going to go through these capital budgeting techniques. This particular chapter now is sort of just kind of basic, slowly walking you into it. And they're going to go through a number of the capital budgeting techniques that we discussed in other videos. And so again, this is just sort of basic kinds of things in this chapter. But again, it's important for you to get these things down and understand, what all we're talking about and things like that. Now, this particular problem reads like this. It reads, Dane Cosmetics is evaluating a new fragrance mixing machine. The machine requires an initial investment of $24,000 and will generate after-tax cash inflows of $5,000 a year for 8 years. For each of the costs of capital listed, calculate the net present value. 2, indicate whether to accept or reject the machine. And 3, explain your decision. In the A part, the cost of capital is 10%. The B part, the cost of capital is 12%. And in the C part, the cost of capital is indeed 14%. Now, there's a couple of things they want you to get here. One is just kind of a decision-making sort of thing, which we'll explain in a minute here. A little bit bigger, more important, maybe sort of thing is to note that as the cost of capital increases, you're going to see the net present value decrease. So in one of the other chapters, we talk about cost of capital and why you want to minimize it, things like that. And again, this little problem kind of demonstrates that, because the smaller, the lower the cost of capital, the greater the net present value of the projects will be. Now, in this particular problem now, they want us to calculate net present value. Net present value, you'll recall, is the present value of the inflows minus the present value of the outflows. Now, the inflows, these are the cash inflows you expect to get with the project. The present value of the outflows, that's the initial investment you have to make. So in this case, they tell us that we're going to have to invest $24,000 into this machine, and we expect it to generate after-tax cash inflows, which is what you would want. That's the relevant cash flows you want to look at. But they expect the cash flows to be $5,000 a year for 8 years. And in the A part, they give us a cost of capital of 10%. Now, that 10%, that's your minimum acceptable return on the investment. Okay? Now, how do you calculate net present value? Well, you find the present value of the inflows minus the present value of the outflows. In this case, the inflows are an annuity, okay? And so to find the present value of the annuity, we multiply the value of the annuity, $5,000, times your PVIFA. In this case, N equal to 8, I equal to 10%. And if you went to your PVIFA table, you'd find that that's 5.3349. If you multiply that interest factor times 5,000, that gives you the present value of your inflows. Subtract from that the cost, the initial investment required, which is $24,000. And in the first scenario, we get a positive $26,7450. Now, again, that's in dollars. And $26,7450 is a positive number. What they'd like you to know is that that would be an acceptable project. And if we added this project, this asset to the business now, we'd add $26,7450 to the value of the firm. If you divided the net present value by the number of shares outstanding that the owners own, that would tell you how much the intrinsic value of each share of stock would go up. That's a good thing. That's what you want to happen when you make these decisions. Now, in the B part, same problem, but they've increased the cost of capital to 12%. And so what you see here now is a reduction in net present value. To find its net present value in the B part, you take 5,000, multiplied by your PVIFA at 8 and 12%, which is 4.9676. Multiply that interest factor times 5,000. That's the present value of your inflows. Subtract 24,000 from it, and you'll get the net present value, which is a positive $838. Still a positive number, and because it's a positive number, that means the rate of return on this asset is greater than the cost of capital. So this asset earns a return in excess of 12%. In the C part now, they increase the cost of capital, your minimum acceptable return, to 14%. And you can see, as you do that, net present value is going down. So in this particular problem, 5,000 times our PVIFA at 8 and 14%, which is 4.6389. Multiply that by 5,000, that's the present value of the inflows. Subtract 24,000 from that, and you'll find the net present value now is a negative $805.50. So do you want to ever add a project with a negative net present value? The answer is no, because if you do, you'll reduce the value of the firm, and you divide that number by the number of shares owned by the owners. That's how much the intrinsic value of each share of stock will go down. That's not what you want to do, okay? So a couple of things here. As you see cost of capital increase, you can see net present value decreases. Basic understanding, basic kind of net present value problem here, and they're trying to get you kind of into the water a little slowly here. But net present value, it decreases when cost of capital increases.